Good morning, everybody. Happy Thursday. It's September 18th, 2025. Great to be with all of you today. I hope you're feeling all right. Certainly, Joe Cocker is. It's time for our look at the markets here, as we do every couple of days during the week. We come at you Mondays and Thursdays with our daily bites. Talk a little bit about the economy, about the Fed, about interest rates, about stock market, momentum, options, trading, charts, you name it, we cover it. So what happened yesterday? Well, the Fed came and went, cut interest rates by a quarter point, as most people expected. Some people were hoping for 50 basis points, but it seems like only one member of the committee wanted more than one rate cut. But as it is, the Federal Reserve came in and cut rates and signaled that maybe likely two more cuts coming in 2025, but only one cut coming in 2026 and one in 2027. Of course, that is uh, likely to change over a period of time, because Chair Powell did come out and say yesterday that the committee is paying more attention these days, more than usual, to the data, right? And remember what he talked about in Jackson Hole? He was setting up for this rate cut that happened yesterday. And what did he say in Jackson Hole? He said downside risks in employment, upside risks in inflation, so it sort of balances things out. But he seemed to express, and the committee did yesterday, that there were heavier risks to the downside if employment does not improve, or it just continues to erode here. So I think that that weighed a little bit more into their decision making process yesterday. So as it is, the market became really volatile yesterday, and of course, moved on every word that he said in the press conference. But here we are seeing the S&P futures up sharply. The market did drop at one point yesterday, and you can see all the volatility here in the markets. And we did bounce back to close just with a little loss yesterday, but overnight we tagged new all-time highs in the S&P futures above 6,700, 6,719. Which means the S&P 500, if we open up here plus 45 handles, is going to be about close to 6,650, a new all-time high. But more interesting for me is the Russell 2000 right now, which is going to be all right. So we had lost our connection. Now we're back. So you can see here yesterday's shot up right after the Fed meeting, Fed announcement, about 244 and change, came right back down and closed a bit lower yesterday. It looks like we're going to open up close to 241 and change. Where is that on the all-time highs? Listen, we know the all-time high on the IWM is right here at just above 240. So if we can close above 240 and a half, or 241, new all-time high on the closing for the IWM, probably for the Russell, for the Dow Industrials, Nasdaq looking to open up at a new all-time high as well too, and the S&P 500. So all four big indices could be printing new all-time highs today after the close. So does that create a problem? Well, not just yet, because we're not really super overbought yet. And I could tell you by looking at the oscillators, plus 21 on the NASDAQ, certainly not overbought. -8 on the New York Stock Exchange, certainly not overbought here. So we're not overbought on these signals over here. on relative strength, sure, some of those indicators are overbought on the MACD as well. Some of those indicators are overbought, and if you look at the S&P 500 and the Nasdaq, no question about it. But remember something: overbought is simply a condition; it's not a signal. It doesn't tell you that you should be taking a reverse stance. It just makes it's supposed to make you aware of the conditions. It's like a red flag. So keep that in mind. Let's go forward. So today we have earnings coming out after the close on FedEx, which is usually a big market mover. And we'll also hear from Lennar, or as we say on the East Coast, Lennar. So that'll be after the close today. And then don't forget, tomorrow is a big day for options, right? What is that? It's a triple options expiration day. We have options expiring, options on futures, and regular index options all expiring on the day tomorrow, all during the day. Some are in the morning, some are during the day, and most of them are after the close. So it's going to be a huge volume print tomorrow. Look for quite a bit of volatility, quite a bit of volume, quite a bit of turnover during the day yesterday, during the day on Friday, especially the last hour and a half of trading. Does it mean anything? Not a whole heck of a lot, because a lot of those people rolled contracts late last week into maybe the futures, certainly into December, maybe options into the next couple of months as well too. Monday, of course, will be the first day of trading for October options, and we'll see some new option strikes open up. If you see something right now that doesn't have any October and Novembers, you see those probably opening up on Monday morning. I like the market right here. What's not to like? The momentum has been very, very good. It's been positive. It's been strong. We've had support from fixed income. We've seen the U.S. 2-year yield coming down sharply from the late part of July with that big move down. We tried to rally up and we failed. This is a yield of the 2-year. We're coming back down over here. How is the economy doing? Well, the economy seems to be pretty strong, and we can also look at high yield junk bonds for an interpretation of how the economy is doing as well too. So this is the HYG high yield corporate bond ETF, and you can see that has been making higher highs, higher lows for quite some time now. It reached an all-time high back in May, pulled back, and it's been making higher highs and higher lows all the way up to where it is right now. So that indicates that the economy is pretty strong. Spreads on junk yields versus treasuries is rather tight. It's as tight as it's been ever. And, that generally means that the economy is strong and it's going to continue to move on nicely. It's when this breaks down and starts moving lower, yield spread starting to widen. That means there's a bit of an emergency going on, a little bit of a red flag there as well, too, for the economy. We have to be careful there that we could be heading into some kind of recessionary period. I don't think that's on the table right now. Certainly, again, looking at some of the data that I've showed you here with yield spreads, with high yield, with 2-year yield, and with and we can take a look at the Fed funds futures right now, portraying an 87% chance of a cut in October, and then another 80% chance of a cut in December. So if we look at the Federal Reserve projections from yesterday, let's take a look at these. You can see that the Fed funds futures projection went down from 3.9 to 3.6. That means the Fed has forecasted 2 more cuts in 2025. But then you take a look at 2026, only 1 cut in 26 and then 1 cut in 27. Again, I think that can change later on in the year next year, especially if inflation starts coming down and the jobs market does not get any better, gets progressively worse. We do see a little bit of improvement in GDP from June, 1.6 to 1.8. But going forward, long-term trend, only 1.8. That's terrible, right? It's not great. That's not growing at trend. But we do see inflation trend also coming down as well, too, from 2.6 to 2.1 down to 2%. So we see long-term inflation down to 2%. The one thing I want to show you here is what Chair Powell said at Jackson Hole. It's very, very important you understand this, because the differential between inflation and where the Fed funds rate is. Chair Powell said that there is about a 1% premium in inflation over the Fed funds rate. And you can see it right there in front of you on this graphic, this table that I'm showing you. Where is that? Do you see the Fed funds rate long run at 3%? Yes. Do you see the PCE inflation projection at 2%? Yes. 3 minus 2 is 1. 1% premium, which is exactly what the Fed is looking at in terms of where the Fed funds rate is going to be. So if inflation only gets to 2.25, where is the Fed funds rate going to be? About 3.25. So if currently right now, with the funds rate at 4% and inflation at about 3, we're priced in just about right. So I think the Fed, in their estimate of trying to push funds rate down to about 3.6, is anticipating that we're going to get to that 2.6 sooner rather than later. You see that 2.6 in 2026. That gets us that 1% premium. 2.6 to 3.6, that's the 1% premium. So that's really what we have to key off of if we're trying to determine where the Fed funds rate is going to go, and or inflation is going to go based on the estimates and the forecasting from the Fed. Okay, hopefully you learned something right there. Here's the dot plot here. Everything kind of pushed down a little bit on the Fed funds dot plot here. It's very interesting that we have one down over here. We know that Stephen Marin, who was recently named to the board, was the only dissenter, saying that we should have 50 basis point cut yesterday. He had an opinion and a view, and that wasn't in line with everybody else, so that's fine. I think that by and large, we're going to see some washy, flip-floppy action over the next week and a half into the end of the month, end of the quarter. You're going to see some large up days. We're going to see some large down days. We're going to see volatility start to perk up. We see the VIX down below 15%. It is very low right now, and I think that we're going to see some people start buying some protection going forward over the next couple of weeks. October has notoriously been a bad month, but it hasn't been a bad month when September was strong. We only have about 7 or 8 trading days left in September, and then we're moving on to October. So it's going to be interesting to see how things finish up this month. So as usual, keep some protection on, raise your cash levels, bank some profits. We're going to have a nice winner today in this new name called Bullish. And I like that chart yesterday, and you can see also Intel's going to be up. They had some news with NVIDIA today. We see Bullish is up about 8-9% here as well too. So we're going to be banking some profits today. So we also but towards the end of the day in the chat room yesterday, what did we do? Put this trade out over here. You can see here, Craig copied me in here. 659 SPY calls at 340. That's going to be up nicely today. That's for next week. We're going to probably bank those sometime during the day. So do your work today. Do what you got to do and make some trades. Keep some cash on the sideline. Wait for the next opportunity to come in, because there's going to be a dip buying opportunity at some point in time in the next couple of weeks. So have a great day. I hope you're feeling all right. Again, Joe Cocker is, and we'll see you guys all Monday morning. Take care. Bye.